Imagine a massive, globally integrated nation that somehow manages to just, well, double its citizens' average wealth in a single decade.
Right, which sounds incredible.
Yeah, exactly. On paper, it looks like an absolute triumph,
Huh.
like a roaring economic engine lifting millions out of poverty.
Mhm.
But then you look closer and you realize this nation actually paid for that wealth
Yeah.
by systematically gutting the very factories, the laboratories, and that dynamic young workforce
Yeah.
that once made it a global superpower.
It's wild.
You're watching an economic miracle that is, in reality, eating itself alive. So welcome to another deep dive. Today we are unpacking a towering, almost intimidating stack of World Bank data on the Russian Federation.
A very tall stack of data, yeah.
Right. And we are investigating a compelling paradoxical mystery that we are calling the growth illusion.
It truly is a paradox. And it's one of the most fascinating case studies in modern macroeconomics.
That's absolutely.
The core question you and I are going to explore today is this. How does a former industrial giant face an irreversible structural crisis right in the middle of a massive resource boom?
Yeah, that's the big question.
Right, because when the euphoria of endless oil and gas revenue masks the harsh reality of, an aging demographic, plunging high-tech capacity, and decaying institutional effectiveness, well, what happens to the underlying foundation of the state?
It's a house of cards.
Exactly, and that is the narrative this World Bank data is mapping out for us.
Okay, let's unpack this. Before we get into the weeds of the data, I want you, the listener, to set up a little theater of the mind.
Oh, I like this.
Yeah, so picture a stark minimalist chart, a pure white background. On the left, there's a dramatically rising green dashed line representing income.
Okay, going up.
Right, going up. But intersecting with it are two solid gray lines just cliff diving downwards representing high-tech exports and a shrinking young workforce. And right where they collide, just imagine a giant, bold, black question mark. Right. That is our mission today. We are covering three massive structural traps.
Right. The first being extreme dependence on natural resource extraction, what economists call the resource curse.
Yep. Second, a demographic winter colliding head-on with rapid deindustrialization.
And third, a severe institutional and fiscal imbalance, where civilian investment is it's starved out by massive spikes in military spending.
But before we dive into those traps,
Yeah.
it is absolutely crucial to set some ground rules for our analysis today.
Yeah, we definitely need to frame this properly.
The source material we are working with today is curated directly from the World Bank and other, international monitoring databases.
It's raw data.
Exactly.
Yeah.
It contains extensive macroeconomic data, including figures on state operations, institutional corruption metrics, and national military spending.
So we are looking at the raw, unfiltered ledger of a nation state.
Right. And I want to be explicitly clear with you, the listener, right up front. We are not here to take any political sides, left or right.
No, not at all.
We are not endorsing any geopolitical viewpoints, nor are we passing moral judgment on the policies or the state actors reflected in these numbers.
Our goal today is strictly, entirely, and impartially to convey the macroeconomic data points contained in these reports.
We are treating this data as a diagnostic tool. We're simply following the flow of capital, the movement of populations, and the shifting of industries exactly as recorded by the international monitors.
Think of us as financial and demographic forensic analysts.
I love that.
The numbers tell a story of cause and effect, of incentives and long-term outcomes. Our job is to synthesize that data, strip away the noise, and help you understand the underlying mechanics of this incredibly complex economy.
All right, so to understand the illusion part of the growth illusion, we first have to look at the magic trick itself.
The headline numbers.
Exactly, the headline economic growth. If you visualize a 2D line graph from the World Bank data stretching from the early 1990s to the present, focusing on GDP per capita, the trajectory looks phenomenal.
It really does.
And we're looking at this in constant 2015 US dollars. But wait, before I throw more numbers out, can you just briefly explain what constant dollars actually means for the listener?
Sure, yeah.
Why do we use that instead of just looking at the raw cash value from the 90s?
That's a vital distinction. So constant dollars is a way of stripping away the illusion of inflation.
Okay.
Because if you just look at the raw price of things, a loaf of bread in 1995 cost a lot less than a loaf of bread in 2015.
Right, inflation.
Exactly. So if someone's income doubled, but the price of bread also doubled, they aren't actually any wealthier.
They're just treading water.
Precisely. By anchoring the data to the purchasing power of the US dollar in a specific year, in this case, 2015, we completely remove inflation from the equation.
That makes total sense.
We are looking at the real, tangible purchasing power and true wealth accumulation of the average citizen over time.
Okay, so looking at the real purchasing power in this 2D graph, the journey this economy took is staggering.
It's a steep climb.
It is. Following the dissolution of the Soviet Union in the 1990s, the economy suffered, well, massive dislocations. The data shows them hitting a low point in the late 90s of roughly $4,515 per person.
Which was a period of severe hardship.
But then the recovery phase begins. That number climbs and climbs, riding a massive wave through the 2000s, cresting over $10,500 per person in recent years.
It's incredible.
It is more than a doubling of real wealth. So here's my pushback question to you. If the average person is twice as wealthy, shouldn't we call that a win? Like, why are we calling this an illusion?
What's fascinating here is that in macroeconomics, the destination matters, sure, but the journey tells you how fragile the vehicle is.
Oh, I like that phrasing.
You are absolutely right that going from roughly $4,500 to over $10,000 represents a massive accumulation of wealth.
Millions of people gaining a higher standard of living.
Exactly. But when we zoom in on the data, this growth is not a smooth, linear progression. It is incredibly erratic.
Bumpy ride.
Very bumpy. The World Bank tracks adjusted net national income growth rates, and it shows violent swings.
How violent are we talking?
Well, you have years in the early 90s where the economy contracted by a staggering 21%.
Oh, wow.
Yeah, followed by years where it surged by 20%, then dropping again by 17% around the 2008 global financial crisis, and then bouncing back again.
It's a complete roller coaster. The volatility is off the charts.
And that volatility is the first massive red flag.
Why is that?
Because in a standard, healthy economy, a doubling of income usually signals structural maturity. Think about a country moving up the value chain.
Like starting with basic agriculture.
Right, agriculture,
Yeah.
then transitioning to advanced manufacturing, and eventually maturing into a high-value service, technology, and knowledge economy.
And when that happens, things smooth out.
When that maturation happens, economic growth becomes much smoother. It becomes more resilient to external shocks because the foundation is diversified.
Right, so if one sector takes a hit, the others stabilize the ship.
Precisely. But because this economy is swinging so wildly, it tells us that foundation just isn't there.
So the erratic nature of the wealth accumulation, followed by a pronounced period of stagnation in very recent years, reveals an economy that is fundamentally fragile.
Yes, the wealth didn't come from a broad-based increase in productive capacity.
It didn't come from, like, technological breakthroughs.
No, or a highly efficient new manufacturing sector. It came from a highly specific, highly volatile external source.
Which brings us to our first major structural trap. The resource curse.
The big one.
Yeah. If the wealth isn't coming from new value creation, where is it coming from? The data points to a rather alarming answer. They are liquidating their natural assets.
They're burning the furniture to keep warm.
Wow, yes. The World Bank tracks a metric called adjusted savings, energy depletion as a percentage of gross national income.
And the visual for this is striking.
Right, picture an area graph. In the early to mid-90s, this depletion rate hovered around 1.3 to 3%. But as global oil prices surged in the 2000s, this metric skyrocketed.
It's just massive jumps.
It hit figures well over 8% and peaked at an astonishing 9.4% of gross national income.
Imagine a big text bubble pointing right at that 9.4% peak.
Yes. I need you to break this down for us. What exactly is adjusted net savings? And why is a 9.4% energy depletion rate such a huge warning sign?
To understand this, we need to shift how we think about national wealth entirely. Traditional GDP, the number you always hear on the news, it just measures the total value of goods and services produced in a year.
It's basically a measure of cash flow.
Exactly. It's just cash flow.
Yeah.
If you cut down an entire ancient forest and sell the timber, your GDP goes up.
Because you made a sale.
Right. You look richer on paper, but you have permanently destroyed a natural asset that took centuries to grow.
So your country is technically poorer in the long run.
Even though you have cash in your pocket today. And this is why adjusted net savings, or ANS, is one of the World Bank's most brilliant diagnostic tools. It tries to correct this illusion.
Okay, so it looks at the actual balance sheet, not just the cash register.
That is a perfect way to put it. ANS takes traditional gross savings and subtracts the depreciation of physical capital.
Like aging bridges, rusting railways.
Degraded factories,
Mhm.
exactly. And crucially, it subtracts the depletion of natural resources.
The oil you pumped.
The oil you pumped, the gas you extracted, the minerals you mined.
Okay, I see.
When we see Russia's energy depletion peaking at 9.4% of its entire gross national income, it means nearly a tenth of its entire national wealth generation in those peak years wasn't growth in the traditional
It was
sense.
just liquidation.
It was simply the act of digging up finite underground wealth and selling it to the rest of the world. And mineral depletion rose alongside it, which just compounds the issue.
So here's an analogy for you, the listener. Imagine you are looking at a company's incredible quarterly profits.
Oh, okay.
The stock price is going through the roof, the CEO is popping champagne, but then you look at the accounting footnotes and you realize they didn't invent a new product or, increase their sales
They
efficiency.
didn't actually grow the business.
No. They achieved those profits by selling off their own factory machinery and pawning the corporate headquarters.
It looks absolutely great today.
The ledger's in the black. But tomorrow is a massive problem because you don't have the machines to make your product anymore.
You haven't built wealth, you've just converted a long-term asset into short-term cash.
Exactly.
If we connect this to the bigger picture, this kind of economic structure creates what economists call a rent-seeking environment.
And this is the heart of the resource curse, right?
It is. When a state can generate massive revenues simply by taxing the extraction of fossil fuels, essentially extracting rents from the earth, it creates a dangerous static equilibrium.
It destroys the incentive for the government to undertake deep, difficult structural reforms.
Because why do the hard work when the money is just bubbling out of the ground?
Right. Building a competitive business environment is incredibly hard.
Enforcing property rights, fighting corruption, and investing heavily in complex high-tech industries takes decades of patient capital and political will.
But if you can just turn on the pipeline and watch foreign currency flood in,
The state becomes complacent. The leadership doesn't need to tax a dynamic middle class to fund the government, which means they don't need to be accountable to that middle class.
wow, so this rent-seeking behavior rots the economy from the inside out.
Because it starves every other sector of attention and investment.
And that rot is starkly visible when we look at our second trap deindustrialization.
Right, the loss of the factories.
Speaking of selling off the factory machinery, let's look at what is actually happening to Russian industry. The World Bank tracks employment in industry as a percentage of total employment.
And this chart is rough.
If you look at the trajectory from the early 1990s, visualize it like a waterfall chart. In the early 90s, industrial employment was over 40%.
More than 4 in 10 workers were in the industrial sector.
Right. From there, it is a relentless downward plunge, settling recently around 27.4%.
That is a massive hemorrhage of industrial jobs.
It really is.
It is a textbook, almost tragic illustration of Dutch disease.
Okay, for those who might not be familiar, what is Dutch disease?
It's a famous economic concept named after a crisis in the Netherlands in the 1950s and 60s after they discovered massive natural gas reserves in the North Sea.
Okay.
When a country exports huge amounts of natural resources, foreign money floods in to pay for them. In Russia's case, the world needs to buy billions of dollars of oil and gas.
Right, and they pay in foreign currency.
Exactly. This massive influx of foreign currency causes the domestic currency, the ruble, to appreciate or artificially strengthen.
Wait, explain how that works mechanically. Why does the currency get stronger just because they sell oil?
Because the global market largely operates in dollars or euros. But to buy Russian oil natively, or for the Russian state to utilize those profits domestically, that foreign currency has to be exchanged for rubles.
Ah, so there's huge demand.
Yes, the overwhelming demand for rubles to facilitate these massive energy transactions drives the price of the ruble up.
Okay, so the ruble is incredibly strong. It sounds like a good thing for a Russian citizen traveling abroad, right?
It is great for a citizen taking a vacation to Paris, yeah. But it is an absolute disaster for domestic manufacturers.
Because their goods become too expensive.
Exactly. Suddenly, a tractor or an airplane built in Russia becomes incredibly expensive for foreign buyers compared to a tractor built in Germany or China.
Oh, that makes sense.
At the same time, cheap foreign imports flood the domestic market because that strong ruble gives citizens immense purchasing power for foreign goods.
Ah, I see. So the domestic manufacturing sector gets squeezed from both sides. They can't export because their goods are too expensive globally, and they can't sell domestically because cheap imports are flooding in.
They simply cannot compete. So capital and labor migrate away from productive industry and flow entirely into the resource extraction sector,
Or there else.
or into non-tradable services like local retail, real estate, and construction, which are fueled by the sudden influx of resource wealth.
Just building shopping malls with oil money.
Exactly. And you also have to consider the legacy of the Soviet era.
The monocities.
Yes. The Soviet Union built massive monocities, entire urban centers dedicated to a single heavy industry, like steel smelting or tank manufacturing.
Right.
When the Soviet supply chains collapsed and Dutch disease set in, these monocities became economic black holes. The factories rusted away and the jobs vanished.
Hold on a second. I need to push back here on behalf of the listener.
Sure, go ahead.
I'm looking at the United States, the UK, and France over the last 40 years, and they all lost a massive amount of heavy industry, too. The Rust Belt in the U.S. is famous for this.
True.
Doesn't every advanced economy eventually shift away from heavy industry? Don't they all naturally evolve toward a modern service and tech-based economy?
It's a fair question.
Isn't shedding factory jobs, dropping from 40% to 27%, just normal economic modernization?
That is a critical distinction to make, and it's a very common misunderstanding. Yes, advanced economies transition, but a healthy transition happens because manufacturing becomes highly productive and automated.
Okay, so they still make things, just with fewer people.
Exactly. A factory in the U.S. might employ fewer people today than in 1980, but it produces exponentially more output because of robotics and advanced engineering.
Right.
This frees up labor to move up the value chain into knowledge-intensive services, software engineering, advanced biotechnology, global finance.
The pie gets bigger, and the work gets smarter.
Precisely. What the World Bank data shows for the Russian Federation is not a healthy evolution. It is a hollowing out.
An emptying out.
The drop in core manufacturing and heavy industry jobs wasn't replaced by a booming, globally competitive tech sector.
It was replaced by a reliance on volatile commodity exports and low-level service jobs.
Exactly. They didn't evolve past the factory. The factory simply closed down, and the workers went to work in retail or resource extraction. The foundational capability to make complex things was lost.
And that perfectly transitions us into looking at the tech sector, or rather, the struggle of the tech sector.
Yeah, the data here is pretty grim.
If the loss of industry was a natural, healthy evolution, we would absolutely see a boom in high-tech exports. We would see that value add. But the data tells a very different, very struggling story.
Picture a bar chart here.
Right, a bar chart with a smooth trend line. The World Bank measures high-technology exports as a percentage of manufactured exports.
And what does it show?
When you look at the timeline, you see a fleeting, almost desperate attempt to climb the ladder in the early 2000s. It reaches a peak of nearly 15.9%.
Which is respectable.
It is, but they couldn't hold it. The metric suffers a severe, undeniable backslide, slipping all the way down to roughly 9.7% recently.
This metric is incredibly telling. High technology exports are products with high R&D intensity, things like aerospace components, advanced computers, pharmaceuticals, and scientific instruments.
Complex stuff.
Right. In the early 2000s, as the country stabilized from the 90s crash, there was a genuine top-down attempt to modernize, to break free from the resource trap.
That they tried to force innovation.
They did. The state poured money into initiatives like the Skolkovo Innovation Center, trying to build a Russian Silicon Valley by decree. And you see that effort reflected in the climb toward 16%.
So why did it fail? What stopped them from making that leap and sustaining it? Why this severe drop back down to 9.7%?
This raises an important question. How can an economy innovate without the foundational institutional support and the organic human capital to drive it?
You can't just order it to happen.
Exactly. Innovation isn't something a government can simply order into existence with a massive grant. It requires an entire ecosystem.
What kind of ecosystem?
It requires secure property rights, so inventors know they can profit from their ideas without fear of state expropriation. It requires an independent judiciary to resolve disputes.
Right.
It requires a deep, continuous pool of highly educated, dynamic talent and a venture capital network willing to take risks.
And as we'll see later when we get to the institutional data, that ecosystem was entirely absent.
Right. Instead of an organic ecosystem, you had top-down bureaucracy. And worse, Brain drain became a massive compounding issue.
People leaving.
Yes, the best and brightest engineers, software developers, and scientists look at the domestic environment, the corruption, the lack of legal protections, the economic volatility, and they left.
They found better opportunities in Berlin, London, or Silicon Valley.
The state failed to create the baseline conditions necessary for a knowledge economy to take root and thrive globally.
Here's where it gets really interesting.
Yeah.
If you take a step back and look at the whole macroeconomic picture we've painted so far, the contrast is stark.
How so?
On one hand, you have this gargantuan volume of raw material exports, literal oceans of oil and mountains of minerals flowing out to the global market.
All right.
And on the other hand, you have this shrinking, anemic sliver of high-value, high-tech output. It essentially turns a massive, historically significant economy into a giant quarry.
A giant quarry.
Yeah, they're digging things out of the ground rather than inventing things for the future.
A giant quarry is a brilliant, if sobering, metaphor. And here is the brutal reality of a quarry economy. A quarry doesn't require millions of highly paid, highly educated innovators.
No, it just needs heavy machinery.
Heavy machinery, infrastructure, and a relatively small, concentrated workforce to operate the extraction equipment.
It does not generate broad-based middle-class prosperity through innovation.
And this leads us directly to the most alarming constraint on their future growth: the demographic reality.
The human element.
If you want to build a tech-driven economy, you need a dynamic, growing workforce. But the demographic data reveals a chilling, deep winter.
Let's look at the numbers. Imagine a dual bar chart in your mind. The World Bank tracks both total population and the total labor force.
Okay.
For years, the total population has been trapped in a stagnant zone, hovering right around the 143 to 144 million mark. It completely lacks any organic internal momentum to grow.
But labor force data is even more concerning.
Yeah, the total labor force is trapped in a hard zero-growth zone, fluctuating between roughly 73 million and 76 million people. The workforce has hit a hard ceiling. It simply cannot expand.
And we have to look at the historical context here. This stagnation isn't just a recent phenomenon. It's an echo of the past.
The 1990s.
Yes. The profound economic collapse and social instability of the 1990s led to a catastrophic drop in birth rates and a surge in mortality.
Demographers call this the Russian cross.
Right, exactly. The moment when the death rate crossed above the birth rate, we are now seeing the echo of that 1990s crisis.
The missing generation.
The missing generation that was never born in the 90s means there is a severe shortage of people in their 20s and 30s entering the workforce today.
So the pool of potential new workers is physically just not there.
It's empty.
But it gets worse, because while the workforce is stagnant, the overall structure of the population is shifting radically towards the elderly.
The silver crisis.
The World Bank tracks the old age dependency ratio. This measures the percentage of elderly people, those typically 65 and older, compared to the working age population.
And the visual here is a steep line graph.
A very steep line graph. When you look at this data, the trend line is aggressive. It starts down at 9.4% and shoots upward to over 22.3%.
That is a massive jump.
And the overall percentage of the population aged 65 and above has broken past the 15% mark, which is the widely recognized threshold for a deeply aging society.
This is where the macroeconomic rubber meets the road. I want you to think about what this means on a human level.
Yeah, imagine you are a listener who is a 30-year-old software engineer or a factory manager in Yekaterinburg. What does a 22.3% dependency ratio actually mean for your daily life and your future?
It means the math of your society is turning against you.
Wow, okay.
When the ratio was 9.4%, there were roughly 10 working-age adults supporting every one retiree.
That's a solid base.
That means the tax burden to fund pensions and elder health care was spread wide and thin. It was manageable.
But now,
at 22.3%, there are fewer than 5 workers supporting that same retiree. The burden on your shoulders has literally doubled.
ouch.
Every single year, a larger and larger portion of the economic value you produce is dragged away through direct taxes or through inflation as the state prints money to cover pension shortfalls, just to support the rapidly growing elderly population.
So as a young worker, your potential for wealth building is being siphoned off.
Yes. And from a macroeconomic perspective, it is devastating.
Because that money isn't being invested.
Exactly. It means an enormous share of national wealth must be diverted from productive investments, like building new tech infrastructure, funding research and development, or improving education into pure consumption and elder care.
It creates a massive structural anchor dragging down growth.
You cannot expand an economy indefinitely when you have a shrinking pool of workers and an exploding pool of dependents.
But
It is a mathematical impossibility unless you have massive, unprecedented leaps in automation and worker productivity. But as we just saw from the failing PEC export numbers, that productivity leap is not happening.
now, in the spirit of fairness and looking at all the data impartially, there's a bright spot in the human capital ledger.
There is, yes.
Picture a split infographic. On the left, an arrow pointing sharply down. The World Bank data shows that infant mortality has plummeted.
It dropped from over 20 deaths per 1,000 live births in the 1990s down to roughly 4 per 1,000 recently.
That is a massive, undeniable triumph for basic public health.
It is a significant achievement, and it speaks to targeted investments made in maternal and neonatal care over the last 2 decades. More children are surviving their first year of life, which is unequivocally good.
But on the right side of the infographic, we have a glass that is only half full.
Right, because surviving infancy is just the baseline. Economists have to look at the overall quality of the human capital those surviving children will represent as they grow up and enter the workforce.
And to do that, the World Bank uses a brilliant metric called the Human Capital Index, or HCI.
Right. And the HCI data here is sobering. The index sits stubbornly around zero 0.6.
Explain to the listener what an HCI of 0.6 actually translates to in the real world.
The Human Capital Index attempts to quantify the knowledge, skills, and health that a child born today can expect to accumulate by their 18th birthday.
Okay.
An HCI of 0.6 means that a child born today in this economy will only be 60% as productive when they grow up as they could be if they enjoyed complete world-class education and full health.
It's like running a national economic engine that is permanently capped at 60% throttle.
That's a perfect way to visualize it. Think about compounding interest. If you invest $1 at 5% interest, it grows steadily. Human capital compounds the same way.
A highly educated, perfectly healthy worker invents a new process.
Which makes the next worker more efficient, which generates more wealth for better schools, and so on. But with an HCI of 0.6, that compounding effect is crippled.
Despite the drop in infant mortality. Right. The overall ceiling on human potential remains stubbornly low. This is due to a combination of factors: the uneven quality of the education system, chronic adult health issues, and severe environmental factors.
The new generation of workers is entering the labor force with a capped potential,
Which severely limits the economy's ability to pivot to that high-tech laboratory we talked about earlier.
You mentioned environmental factors. This leads us to a truly hidden ledger in this economy.
The environmental toll.
So the workforce is shrinking, it's aging, and its potential is capped at 60%. But the resource-heavy industries they do have, that giant quarry we discussed, are exacting a massive hidden toll on the population's health and the nation's true wealth.
It's a double whammy.
Let's look at the environmental data. The World Bank tracks adjusted savings, particulate emission damage, and adjusted savings carbon dioxide damage, and the numbers are astronomical.
Very.
Carbon dioxide emissions consistently hover between 1,300 and 2,400 million metric tons. And the cost of particulate emission damage is frequently calculated at over $2 billion annually, sometimes much higher depending on the year's valuation.
What is absolutely vital to understand here is that the World Bank isn't just presenting these numbers as abstract ecological concerns.
Not just save the trees.
No, they're not just saying pollution is bad for the trees. In the adjusted net savings framework we discussed earlier, these environmental damages are literal financial subtractions from the nation's wealth.
They are a tangible economic cost.
Exactly.
Can you clarify the mechanism there for the listener? How exactly does particulate matter like smog, dust from mining, heavy factory emissions translate directly into lost labor income?
It's a very direct, brutal biological and economic chain of causality.
Walk us through it.
Particulate matter, specifically PM 2.5, which is microscopic dust, and soot penetrates deep into the lungs and the cardiovascular system. When an economy relies heavily on massive, outdated, heavy industry, Soviet-era smelting plants, and resource extraction without strict, modern environmental controls, the population breathes this in daily.
The biological result.
Skyrocketing rates of asthma, chronic obstructive pulmonary disease, heart attacks, and strokes.
And economically.
From an economic standpoint, this translates into millions of sick days where workers are absent.
Right.
It means workers are operating at severely reduced capacity on the factory floor or in the office because they are chronically ill. It means a massive surge in healthcare costs, burdening both the state and the individual.
And lost years.
And most tragically, yes, it means premature, death-removing, highly experienced workers from the labor force entirely, years before they reach retirement age.
And the World Bank calculates that.
The World Bank actuaries calculate the economic value of those lost years of life and that lost productivity, and it runs into the billions of dollars every single year. It is a direct, ongoing destruction of the very human capital they desperately need to transition the economy.
Wow. So let's recap the situation we are looking at.
It's a lot.
We have a severely aging population. We have a tech sector that tried to launch and failed, falling back to 9.7% of exports. Sure. We have a workforce that is entirely stagnant in size and suffering billions of dollars in health-related productivity losses due to heavy industrial pollution.
Right.
If you were managing this economy, you would look at this dashboard, see all the red flashing lights, and realize you need a massive, urgent intervention.
You'd hit the panic button.
You would expect the state to take all those billions of dollars in oil and gas rents and pour them directly into fixing these human capital issues, building world-class universities, modernizing hospitals, funding green tech, and subsidizing civilian research.
That would be the logical move.
But where's the money actually going?
This brings us to our final structural, trap-severe, institutional, and fiscal imbalance.
Okay, let's get into the institutions.
Before we look at where the money is going, we need to look at who is managing it and how the system operates. The World Bank uses Worldwide Governance Indicators, or WGI, to measure a nation's institutional health.
And let's visualize this as a scatter plot.
The data here is deeply concerning. Both government effectiveness and control of corruption are plotted entirely below the zero line, deep in negative territory.
The control of corruption estimate plunges to an abysmal negative 1.14.
That is a staggering number.
To be that deep in the negative means corruption isn't just an anomaly or a few bad apples. It's a systemic feature of the economy. It is the operating system itself.
Exactly. And it gets worse when we look at the global percentile rankings. Imagine a funnel chart pointing down. Voice and accountability, which measures a citizen's ability to participate in selecting their government, as well as freedom of expression and association, has collapsed to roughly the 13.2 percentile globally.
That's incredibly low.
Regulatory quality, which is the ability of the government to formulate and implement sound policies that permit and promote private sector development, has slid down to the 12.7 percentile.
Let me stop and translate that for the listener, because percentiles can sound abstract.
Yeah, good idea.
That means out of 100 countries on Earth, almost 87 of them have better regulatory environments for starting and running a business. That fundamentally erodes the foundation of a modern economy.
It destroys it.
I want you to imagine being a 25-year-old entrepreneur in Moscow. You have a brilliant idea for a new tech startup, but you look around and see that corruption is rampant, meaning you might have to pay bribes just to keep the lights on.
Right.
Property rights are weak, meaning if your company becomes successful, a well-connected oligarch or state official could simply take it from you. And regulatory quality is in the bottom 15% of the world, meaning you are drowning in arbitrary red tape. What do?
You don't build your company there. You take your venture capital, your intellectual property, and your ambition, and you leave. Or worse, you just don't build the company at all, and that potential innovation is lost to the world forever.
It's that brain drain again.
This is the mechanism behind that plunging high-tech export line we saw earlier. Bad institutions actively repel innovation.
Which brings us to the ultimate fiscal shift. The state is collecting massive resource revenues from the energy sector, but it lacks the institutional capability, the regulatory environment, or the political will to invest them efficiently into the private sector or human capital.
So what do they spend it on?
The data points to a dramatic pivot toward massive, non-productive expenditure. Let's look at the World Bank data for military expenditure as a percentage of GDP.
Picture a bold bar chart here.
For a long time, it sat relatively steady, fluctuating around 3 to 4%. But then the data shows a jagged, dramatic spike. The expenditure suddenly shoots upward, hitting a staggering 7.05% of GDP.
This is a monumental shift in capital allocation.
I want to remind the listener again of our impartiality rule here. We are not discussing the geopolitics behind this spending, nor the military strategies involved.
No, we are acting purely as macroeconomists looking at a national ledger.
And on a macroeconomic ledger, Military spending is overwhelmingly categorized as non-productive expenditure.
That is correct. We have to look at the concept of opportunity cost. In macroeconomic terms, building a tank, an artillery shell, or a missile does not create a compounding asset for the civilian economy.
Right, going back to your compounding interest analogy.
Exactly. If the state spends $1 billion building a new highway system, businesses can use that road for decades to transport goods faster, lowering costs and increasing trade.
The investment compounds.
If the state spends $1 billion educating children, those children will become engineers who invent new software algorithms. The investment compounds.
But if the state spends $1 billion building a tank,
That tank consumes highly skilled labor, high-grade steel, and massive capital, and it produces an asset that either sits idle in a depot or is actively destroyed. It does not generate future civilian wealth.
so in a country with a fragile, resource-dependent economy, a plunging tech sector, and an aging, shrinking workforce suddenly doubles its military expenditure to 7.05% of its entire GDP, it is making a massive society-altering trade-off.
It is the classic economic dilemma of guns over butter pushed to an absolute extreme.
Guns over butter.
Every ruble spent on defense is a ruble crowded out from the civilian economy. It is capital starved from the education system that desperately needs to raise that zero 0.6 human capital index.
It is capital starved from the healthcare system that needs to fight the particulate emission damages.
And is capital starved from the R&D needed to reverse that plunging high-tech export line. The state is cannibalizing its future potential to fund immediate military capacity.
So what does this all mean? If we step back and look at the entire board we've laid out today, visualize dual lines showing mineral rents fluctuating wildly.
The resource rents, the oil and gas money, they are highly volatile.
They are entirely dependent on global commodity markets that this country does not control.
And instead of taking those temporary windfalls and saving them for a rainy day, or investing them aggressively into fixing the dying industrial base or the dwindling youth population, the state is burning that capital in non-economic, non-productive sectors.
The scale is tipped entirely away from the future and entirely toward immediate state-directed consumption.
It creates a supreme vulnerability. They have locked themselves into a static equilibrium where survival depends entirely on the price of oil and gas remaining high, while the internal pillars of the economy, the institutions, the technology, the people, are actively decaying.
It's a very fragile balance.
It's very fragile.
This brings us to our conclusion. Let's recap the growth illusion for the listener.
Okay.
We started with the paradox of a rising GDP per capita.
Yeah.
But we've seen that this rising wealth masked a hollowed-out industrial core suffering from Dutch disease.
It masked a failure to launch in the tech sector due to brain drain and poor institutions.
It masked a rapidly aging, deeply burdened population with a capped human potential.
And it masked a massive fiscal pivot away from human investment and towards non-productive military expenditure.
Imagine a visual of a fork in the road. One path leads down resource dependence, military squeeze, and demographic decline. The other points up institutional reform, human capital, and innovation.
To change course to that upward path, this economy would have to take a radically different approach. It would require fundamentally reversing the slide in corruption control and regulatory quality.
Which is not easy.
No. It would require shifting that massive 7.05% military expenditure back into civilian R&D, green technology, and public health to lift that human capital index.
Without that massive structural pivot, the growth illusion will eventually be shattered by the harsh, unavoidable mathematical realities of the demographic and institutional winter.
It's just a matter of time.
Which leaves us with one final provocative thought, something for you, the listener, to mull over long after this deep dive ends. We have seen how fragile this entire economic structure is. It is a massive economy, yes, but it functions like a house of cards, held together almost entirely by the temporary, volatile high prices of fossil fuels and mineral rents.
So the lingering question is this. What happens to this demographic, institutional, and fiscal house of cards when the global economy inevitably transitions away from carbon?
Oh, wow.
As the world shifts to renewables and no longer demands the massive volumes of oil and gas that are currently propping up this entire system, how does a nation survive the future when it has already sold its future to pay for the present?
A heavy question, and a perfect place to leave it. Thank you for joining us today, for walking through the data with us, and for exploring the structural reality behind the illusion. We will catch you on the next deep dive. Keep questioning the numbers.